Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, May 22, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And today we had a light volume day. As you can see, the volume thus far was 47, almost 48 million shares. That'll move up a little bit. I'm doing this video a little bit early, so there's still some activity going on for the next few minutes here. But all in all, it was a positive up day. We were up across the board. And what I've done is put in a line on the chart at $240.08. And that's an important number for a couple of reasons. Number one is, I believe the market is heading towards filling that gap. That's common and normal market behavior. The reason I put the line up there is not because of the gap alone, but because if we close the day, any day, above that level in the short term, right here, meaning over the next few days, then my take on that is that's going to produce, or it can or should produce, a vacuum to the upside that could lead us up maybe 40, 50 handles in the SPDR, and that brings us up to 244, 245, maybe even the $246 number that I've mentioned some time ago. We'll see if that happens, but first we have to close above 240.08. That's not going to be easy for the market to do. I believe that's a tall order. Now, off the lows from the 17th of May, we've had a pretty good rally for 3 days in a row, Thursday, Friday, and today. Now we've closed above the 20 moving average, which is positive, and on Friday, we said that close was positive because we got back in this former range. This was I'm not going to call it a bullish consolidation range because it was really uptrending, and that's not necessarily bullish consolidation, but we'll just call it a range. We got back in that range on a closing basis. I said prior to that coming that was important and that would produce more market upside, and that's what we got today. But that gap, it's really the $240. The true number that I'm looking at is more like 240 between 15 and 240.25, but I'm using the gap as a benchmark. If we close up in that range up there, then I believe the market could easily take off to the upside. I think it'll cause a lot of short covering, and that also is called panic buying, and that also spikes the market higher when that does occur. However, let's go to the other side. The other side of it is that we've had 3 powerful up days in a row off the bottom made last Wednesday. And generally speaking, the market, at least on a very, very short-term basis, is overbought and needs to pull back or consolidate, one of the two. And just to accentuate that point, if you look at the 60-minute chart, you can see here the type of rally that we've had in just a couple or 3 trading sessions. That's 40 S&P handles. So if we go up and fill the gap, that'll be about 45 S&P handles. Maybe they spike it a little bit intraday. Could be up to 50 handles. And that's overbought in a 3-day basis, at least the way I look at the market. And the market would need to pull back or consolidate. So my expectation is if we run up and fill the gap, I think it's going to be a short-term resistance point for the market. If we don't and we pull back or consolidate first, then that whole scenario that I just pointed out or put on the table, let me get back to the daily chart, really has to change, because if the market pulls back before it gets to the gap, then everything changes because the market will be most likely building energy to trade through the gap. What I just mentioned over the last couple of minutes is really predicated on getting there within the next day or two. Remember, this is the last trading week before the Memorial Day holiday, which is a 4-day trading week, so we're off, or the market's closed next Monday. And generally speaking, leading up into a holiday weekend, the market tends to float up into the holiday weekend. It doesn't have to. That's just generally what happens. There's no technical reason why. It's just if you go back and look at 3-day weekends leading up into a 3-day weekend, the market tends to float up. And why is that? A couple of reasons. Number one is the volume tends to dry up because a lot of people will actually leave for the holiday weekend ahead of time. They'll take off Thursday or Friday or both. And generally when the volume is light, we know that the path of least resistance tends to be higher. So that's one of the main reasons why we tend to float up or trade higher into a holiday weekend. So there's my synopsis for this week's Spider. I think if we go and fill the gap, it's a resistance point, at least in the short term. If we don't, then we'll consolidate first and most likely be able to trade through it and continue higher. So let's see what happens over the next couple of trading days. Obviously, I'm watching it like a hawk. So let's go over to the IWM. Net, the Spider was up about 0.5% today, and the IWM was also up about 0.5%. So there's no leading or lagging indication one way or the other from the IWM. But what you do see here is from a longer term perspective, it is lagging the Spider. It's nowhere near the highs, and we've basically been stymied a little bit by the 50-period moving average. We closed pretty much right on it today, a few pennies short of the 50-period moving average. So in order for this market to get going, the IWM really needs to get going also. Without the IWM and without the transports, which we'll talk about in a minute, the market's going to have a difficult time going much higher. In order for the broader market to make the move that I talked about a few minutes ago, it's going to need broad participation. You're going to need participation from everything across the board. A rising tide will lift all boats. The S&P is not going to go up 40 or 50 handles and the IWM stay flat. That's just not the way it works. So intraday, the IWM was on par for the most part with the Spider. On the daily chart, it is the lagging index and needs to catch up or at least get moving. It doesn't have to make new highs. It just has to get moving on the upside. And generally speaking, that will drag everything else up with it as well. Let's head over to the transports. Similar story in the transports. The chart looks similar to the IWM, but with the transports, what we do know is without a daily close above 9,005, the transports are making a bearish wedge pattern, and unless and until they can close above 9,005, then and by the way, the moving averages are sloping down into that area. So there's a lot of what's called overhead resistance in this zone. You have the red candle high at 9,004 and change. I'll call it 9,005. You have the moving averages right above, and you have all this chart consolidation that's also in this general area right here. So with all those three things, that's called overhead resistance. And until and unless the transports can make a significant move to the upside, and likely they would have to jump over the moving averages. And when moving averages and a consolidation point are above the market, hence again, overhead resistance, in order for the market to make a significant move to the upside, you'll generally have to see or do see a gap higher above those levels, and that frees the market to move higher. Until and unless we see the market above those levels, the overhead resistance is going to provide pretty heavy resistance for the transports. If this bearish wedge pattern did play out to the downside, the likely stopping point is 85.75 on the downside, the 200-period moving average. We came really within a stone's throw of it. I don't believe we touched the 200-period moving average last week, but that's off the table now as support because we came so close and bounced higher. Therefore, if the market did come back down again, the probabilities are that we trade through the 200-period moving average down to the 85.75 area. All right, so that covers the market. That's a pretty good synopsis. Let's go over to the gold market. Gold had a decent update today, up about 0.5%, just a touch more, about $7. And if gold can close above let me move this over so we can see the numbers if you want. If gold can close above the 1265 area, the next natural area of resistance will be 1272, not far away. And then we go to this pivot high at, call it 1280, but more likely it'll be about 1285. A lot of resistance up in that area. What I see happening, and I'm not necessarily discussing correlations, but what I am discussing is if we did see any kind of a sell or temporary sell in the market, based on how gold and the market have been acting together lately, meaning an inverse correlation, not every day, but for the most part, that's what's been happening as the market was selling off, gold was rising. So if that stays together and we do see some kind of a pullback in the market, those are the upside targets that I would see as resistance points for gold. We are above all the moving averages. That is positive. But to make any significant move to the upside, gold would need more time to consolidate down in this area. It's a little bit early from where we are from the big up move that we had last Wednesday. It's a little bit early to make another up move like this without some kind of an event or related event. On the downside, your 20 moving average will be supportive of the market, the $1,245 area, 1244, in that neighborhood. I'm not suggesting we're going down there tomorrow or anything like that. I'm just saying if we did sell in gold, I think we would find support down in that zone. And if in fact we broke that area, you'll find more intraday support at 1236, 1237 area. Next up, silver. This had a heck of a move today. Silver was up over 2%, making a run for the 50-period moving average. First is going to be resistance at 1729, and the 50 comes in at 1748. Call it 1750 for argument's sake. That will provide resistance to the market for sure. Why do I say that? Well, just below the 50-period moving average is the 50% retracement from pivot high to pivot low. So here's your pivot high, pivot low. Retrace about 50% comes in right about here. Not uncommon for the market to pierce through that, getting to the 50-period moving average. However, slightly above that comes in the 618 retracement. So when you have a 50% retracement, a 618, and a 50-period moving average somewhere in between, you know that that's going to be at minimum of a short-term resistance point for the market. It would be very uncommon for the market to just blow through that right away. And right above there comes in the 200-period moving average on the daily, which is at 1788. So you have a lot of overhead resistance coming in silver as well. And in fact, this is even more of a rally off the bottom than I expected. Once we started to trade off the bottom, I wasn't sure we were even going to get this high. I was calling it a dead cat bounce in here and was thinking that we might even turn back down at the 20 moving average. It did for one day, and now here we are rallying through it. So nice big move for silver. We'll see how high it can get, but we'll run into resistance shortly. Next up, we'll take a look at crude oil. Crude is just about at resistance. Today's high was 51.43. 52.19 is the 200-period moving average. You're going to find resistance at 52 to 52 and a quarter. Maybe they squeeze it to 53 on a rally to the upside, but that's it. Crude has to pull back. It's overbought on a daily chart and needs to consolidate or pull back or both. It's been a fantastic move off the 45.92 area, but now it's overbought on the daily chart, and it's going to need to, at minimum, of consolidate. More probable is a pullback or a retracement of some portion of the move off the bottom. And the bottom isn't 45.92. The bottom's all the way down here, down in the 43s, and from there to here is a pretty big move. So we're going to need to consolidate or pull back. I believe it's going to pull back. But after a pullback or a normal retracement, a garden variety retracement as I like to call them, it can certainly move higher. But from here, we're going to run into resistance and it's tired and needs to stall out for a while, does crude oil. You can't buy it here for certain, but if it did get up into the 52s, traders who trade crude oil can probably short the 52 to 53 area if you're so inclined. I don't think it gets to 53, but it can get to 52, and 52 would be a shortable level, specifically a pierce of the 200 period moving average. Heading over to the bond market. And here we are with another flat day in the bond market. And you know what I always like to say, that the bond market participants or traders are smarter than the stock market guys. And the market was up again today. The stock market was up again today. And the bond market was again flat, similar to what it was up a smidgen on Friday and Thursday. And that tells me, and we're making a bullish consolidation pattern. This tells me that the bond market is consolidating to move higher. Now, if the bond market's consolidating to move higher, is the stock market going to move higher at the same time? Anything's possible, but I don't think it's probable. So one of those two things probably should break apart, and I'm thinking that the bond market wants to move higher, and the fact that we are coming into what I consider a pretty solid resistance point in the stock market, I think if bonds move higher, we'll see some kind of a pullback this week in the stock market. Now, I'm not suggesting or forecasting that today. I'm just saying if we hit my resistance point in the stock market and we pull back, I won't be surprised to see the bond market going higher. That's the scenario that I'm putting together. It's the puzzle that I'm putting together. Each of these components are a piece of the puzzle. I'm putting them on the table, and this is the way I'm putting it together based on what I see across the markets. I certainly don't think it's out of the question for bonds to test this double top area that comes in at 155.16. And remember, we had a 155.20 on the board. I took it off, but it was just above this level. We came up short, we pulled back, so I took it off. But that was the level. In fact, we could take this off as well. Don't need that anymore. That was the level that I had identified as bonds reaching as a target. Never got there, came up short. That happens, and pulled back. But I wouldn't be surprised to see us get up there on this run also. Last up, we'll take a look at the dollar. And what do you know? The dollar came just short of the trend line. The bottom portion of this channel that we've been watching for quite some time. We're still hovering around my original downside target at 96.97. This is an area that should find support in the dollar. So we'll give it a few days, but the dollar should not move much lower from here. Even if it does move somewhat lower, sometimes we'll have what's called a throw up. Well, I'll call it a throw under. A throw over would be on top. A throw under is on the bottom. So a throw under outside of this channel, and that will generally trigger a buy signal. And we're getting very close. There's already been a buy signal on the dollar. There's been a short signal on the euro. And so we should be finding support for the dollar. We should see a reversal in the very near future in the dollar. That's the way I see it. That's my story, and I'm sticking to it. And folks, with that, it's everything I wanted to discuss tonight, so I will leave it there. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.